What's up guys, it's Cryptrader again. I'm making this video today on the conditional orders like stop loss and take profit that have just been added to mainnet. The conditional orders are very important for risk management when you are unable to actively manage a position. If you plan to step away or even hold a position overnight, you will need to know how to set a stop loss. I will also discuss how you can set a conditional order that will open a position upon a breakout of a technical level, so you don't have to worry about missing out on critical price movements. So first off, let me show you where you can find conditional orders. And as you can see, I'm on the testnet. I have a running position on mainnet right now. So I wanted to go to testnet because, I can mess around in here and be able to show you guys a little bit easier. So if we go to the tools next to the recent trades right here, you can see how you have a traditional order box right here. So you have your limit, market, and then your conditional orders are going to be right here, third on the top. And so you can click this drop down. So you have a stop limit, which is a limit order that can be used as a stop loss, and then stop market, which is a market order that can be used as a stop loss. And you have take profit limit and take profit market. So it's the same thing for take profit. You have limit and market. And so what I'm going to do is go through each one of these. I'm going to start with stop market first because I think that's what most people should use, and that's what I prefer whenever I'm using a stop loss, because when you use to set a stop loss, you want it to be a market order because you want to make sure that you get filled. If it's a limit order, then it's just going to sit at the level that you specify, and you might or might not get 100% filled. A market order is going to take however much liquidity it needs to get filled. So I'm going to start with the stop market. So I'm going to select that. And what I'll do is go ahead and get into a position here. I'm just going to click one contract right here. I'm going to long at 93.55 by clicking right here into those sell orders. And so you can see I'm in a long position now. I'm using 100x leverage here on testnet, so you can see my liquidation is pretty close. And so I want to set my stop somewhere in between here. And just for example, I'm going to set it at 93.50. So when we go up here at the stop market that we have, I'm in a long position of one contract, so my stop needs to be a sell order, so I need to click right here at sell. And then the next thing you'll see is the trigger. So what do you want to be the trigger for the stop loss? And so you have only one option right now, and then that's spot price. Eventually there's going to be futures price added, so instead of the spot price being what triggers your stop loss, it can be the futures price. But right now we have to select spot. And so that means that this spot price, which is an aggregate of 4 spot exchanges, is actually going to be what triggers your stop loss to execute. So this trigger price is what that is right there. And so let's say at 93.50 I want it to trigger my stop loss, and I want the quantity to be one contract because I'm in a one contract long, so I want a one contract sell at 93.50 to take me out of my position. This little slider right here, I don't know that you'll need that. That's mainly for these other order types. It's easier to get a proportion of how much your available balance is on your quantity, so you can see if you hover over that. But for the stop, it's not really as value added to use that because you're just entering in whatever position size that you're currently in. And so let me re-enter this 93.50. That's where we want our stop set. And then you can come down here and you see allow position increase. That's not going to apply to you unless you want to have this conditional order open a position instead of actually closing one out. Like I'd mentioned earlier, I was going to show you how to open a position if there's a breakout and you're wanting to not miss out on a move. You can actually have a conditional order open a position for you. And that's where you'd need to select this. And also the other reason that you would probably need to select this is if you're wanting to flip direction. So let's say at 93.50 I was wanting to flip from long one contract to short one contract. I could change this to 2 and then check that, and it would sorry, I need to be on sell here. So on sell, I would sell 2 contracts at 93.50. One of those contracts would take me to neutral out of a position, and then the other contract actually flips me short. And so if I have that checked, it allows me to be able to do that. If I did not have that checked, then this order right here would essentially just take me to 0. so I'm out of a position instead of flipping short because I don't have that selected. But in this case, we'll just, we have it at 1 because that's what our open position is. We're 1 contract long. We want to do a 1 contract market sell to take us out of the position if we hit 93.50. And so it looks like our spot price is already down below 93.50. So I'm going to just change this to like 93.48. It's just right below where we are currently. Just for an example, so I can see this actually execute and see we're actually at 93.47 now. So I'm just doing this for educational purposes. So let's see if we can do 93.45 since we're hovering right around that. And so when I place this order, you'll see it shows up. Well, you get this notification here, and then you see the delayed action actually show the order up right there. And see, it went down below 93.45 and it executed, and we were out of the position. So I'm going to go ahead and get back in and do this one more time just so you can see. I'm going to long right here at 93.50. Longed into those sell contracts right there. And so let's do this one more time so we can make sure. I want it to be on there longer so I can show you what was going on here. So let me put something a little bit lower. 93.30, we'll do something like that. 1 contract at 93.30. Place order. So we get our notification, and then you come down here and you can see the date and time that the order was placed. Good till canceled. That's what you want for a stop loss. That means that the order is not going to be canceled for any reason unless you actually cancel it yourself. It's a market order, which is what we want. Stop market. Sell 1 contract at 0. Since it's a market order, it says 0 here. Whenever we do a limit order, it actually show the price that your limit order will be placed at right there. And then it says if spot is less than or equal to 93.30. So this spot right here will have to get down to 93.30 or less for us to trigger. Doesn't mean the futures price. The futures price can trade at 93.30 and it won't trigger, but as soon as the spot price goes below 93.30 or equal to, then the stop loss will trigger. So I just wanted to do that again just so I could show you that. But I'll do an example of a short now. So I'm going to cancel this. Now I'll do an example of a short position. So I'll click right here, sell into these buyers right here. So I'm in a 1 contract short. Now it's just the opposite. I don't need a sell order, conditional sell order to get me out of this position. I need a conditional buy because I'm already in a short. So I'll do a buy, and we'll do it fairly close to see if we can get executed here. So we'll do 93.40. It's bouncing around a lot, but let's do 93.50. See if this comes back down for a second. So 1 contract at 93.50. Remember, you don't have to have this checked because we're just trying to close this 1 contract out, and that's what we have right here. So if I place the order, you get the notification. You can see it down here. So let's watch this spot price. If it goes above 93.50, then our short of 1 contract will get canceled, or will get closed out with the 1 contract long market buy that we have down here as the conditional order. So you see how it jumped above 93.50 there, and it closed us out of our position. And so it did exactly what we wanted it to. And so that's how the stop market works for being in a long or a short. Now we'll go to stop limit now. And so for stop limit, let's just go ahead and get back into a position again. So we'll get into a long, left click right here, buying into those. So we're in a position now. For the stop limit, what you'll need to do is, it's got a couple different, well, it's only got, I guess, 1 or 2 different things different than the stop market that you'll notice here. So you had good till canceled, which if you notice, the stop market was always good till canceled. But for stop limit, you have a couple of other options here. So you don't have to have the order good until you actually physically cancel it. You can do good for the day, so it'll cancel at the end of the day. Good till funding, it'll actually cancel before the funding interval is up. If you come down here in the bottom right, you can see how much time you have left in your funding interval. It's every 8 hours. There's like 2 hours and 11 minutes left right now. Immediate or cancel, what that means is You can actually hover over this right here if you want to know what any of this means. So you hover over the little question mark there. Immediate or cancel is orders are executed immediately. If the order cannot be partially filled, it is canceled. If the order cannot be fully filled, the remainder is canceled. And then fill or kill is orders are executed immediately. If the orders cannot be fully filled immediately, it is canceled. And so it's a nice little, I guess, hint of what everything is right there if you hover over that. And so then you have the same trigger, so the trigger is still the spot price. That's what you have to use right now. And then, so for the stop loss limit order, for the trigger price, what you'll do is, this is the good thing about the stop limit. I don't prefer to use the stop limit, but the good thing about it is you can set how much slippage you want. So I'm in a one contract long right now. What I'll do is I'll set a trigger price down below. So let's say at 93.30, I want my stop loss triggered, and so I'll put 93.30 here. And then the next price here is where I actually want my limit order placed. And so at 93.30, let's just say the price is coming down, it's going against us, we're in this one contract long. It gets down, the spot price gets to 93.30. It triggers our stop loss. Now we need to specify where we want the actual order placed. So what you can do is go down below 93.30 and place it however many ticks below 93.30 you want. So essentially you're setting how much slippage you're willing to take on the stop loss, and if it doesn't fill, it doesn't fill, it just keeps moving against you. But at least you can set how much slippage you're willing to take. But the main difference is you might not get 100% filled, whereas the stock market's going to fill you no matter what, and you might end up with slippage. So at 93.30 we want this to trigger, and I'm going to say I'm alright with, after it triggers, I'm alright with 2 ticks of slippage. So I'll set my limit sell at 93.20. And so if I do that, limit price at 93.20, one contract, and this needs to be a sell, so we come up here and do sell because we're in a one contract long. And so when I place this order, before I do that though, you can see down here it says sell one contract at 93.20. That's the price we want the limit order actually set at, but it doesn't get placed until the spot goes below 93.30. So when this spot price hits 93.30 or less, it's going to place our limit order right here to sell. So most likely there will be liquidity right here, and so it'll actually fill us up here higher. But if the liquidity is not there, we're willing to get filled down to 93.20. Now if there's no liquidity down to there, we might not get filled and our order would just be left here at 93.20. So that's the downside to the stop limit. The upside is you can set how much slippage you're willing to take, but the downside is, you might not get filled. And so I'm just going to go ahead and place this so you can see, you get the notification for this. You see down here, it's good till canceled. Obviously, you could change that to whatever you want for the stop limit. And then you can see how it says limit sell or limit order sell one contract, and now it's showing us the price that the limit order is going to be placed at, whereas on the market order it showed 0 right here. And then if spot price is 93.30. So just to reiterate this one more time, I'm in a long position at 93.50. If the spot price hits 93.30, it places a limit sell at 93.20. If there's liquidity up here, whenever that happens, when it triggers at 93.30, I'll get filled up higher. If there's not liquidity, then I'm alright with getting filled down to 93.20 because that's what I specified. If there's no liquidity at all, my order will just be the new lowest ask in the order book, meaning that I might not get filled and the price will just keep going against me. So that is why I recommend using the stop market and not the stop limit. But this is just a nice feature for those that want to have, in unique circumstances where you want to be able to set how much slippage you're willing to take. And so I'm just going to go ahead and cancel this because we're not going to get down to that price level. And I'm just going to right click right here and get out of this position. And then we'll do a short position, just so for an example. So I'm in a one contract short right here, and we need to do a buy order now. And so I'm gonna do all the same stuff here, but let's just say, just for fun, we'll just say we want this one to cancel at the end of the day. So we'll say good for the day. Spot price, we have to use that. And in this case, we'll try to get this one to, we'll actually try to get this one to execute. So at 93.50, we want to, let's say the trigger is 93.50 because it's very close. We should be able to trigger that. So we're going to make the trigger price 93.50. And since we're in a short position, we want to do a buy. And so we have the trigger at 93.50 right here. I'm going to do a limit price of, we'll say if spot hits 93.50, I'm okay with 2 ticks worth of past that. So I'll say 93.60 for my limit price, and we'll do one contract, and all that looks good. So we'll place the order. And so let's wait and see when this hits 93.50. What it'll do when it hits 93.50 is it'll place a limit buy order right here at 93.60. Okay, and so it happens so fast you don't even see it play out because it's only one contract. So one contract is getting filled basically right here whenever it hits the trigger at 93.50 because there's plenty of liquidity for just one contract. But if I was like, let's just say in a bigger position, let's just do something a little bit bigger. So 1,000, we'll do 1,000 contracts. So let's get into a short position right here with 1,000 contracts. So doing the exact same thing, we'll change the quantity. Exact same setup right here. 93.50 is when I want it to trigger. When the spot price hits 93.50, I wanted to put my limit buy right here at 93.60, which is what I have. So I'm essentially setting how much I'm willing to slip, and so my order will stay, it'll go right here and try to get filled. And so if it happened right now, you can see there's not even enough liquidity to fill 1,000 contracts because there's only about 17,700, 100. And so if I had 1,000 contracts right here, it actually wouldn't get filled, and there would be a little bit left at this level. Now if the price kept going against me, then I wouldn't get 100% filled. But let's wait for a second and see if this comes up to 93.50 and see if you can see it actually happen to where there's a little bit left over right here at 93.60 when it gets placed. Okay, there we go. If you saw that, it happened very quick. If you can just rewind this and slow it down a little bit, what you'll see is as soon as this spot price broke 93.50, which was our trigger price, you will see that there were 1,000 contracts placed at 93.60 because that's what we specified here. And they actually sat there for a second before they could get filled because there wasn't quite enough liquidity through here. And so that's just an example of how you can set a trigger price and set how much slippage you're willing to take and have the order sit there and get filled. So I hope that helps. If you have any scenarios where a stop limit might be helpful like that, where you need to set how much slippage you're willing to take. But I would recommend just using stop market. Now the next orders that we would be looking at here are take profit. Now you don't have to use a conditional order for take profit. It's just up for preference really. For me personally, like if I was to get in a position, let's just say a long right here, get into a 10 contract long right here, 93.50, what I would do is set I would just click here on the ladder for a limit order for my take profit most likely. Like let's just say I wanted to go like 3 ticks in my favor. I want to take a profit at 93.65, 3 ticks in my favor. Then I would just left click right here and place my limit order up here of 10 contracts to get me out of this position. So it wouldn't be a conditional order, but for my stop it would be a conditional order. So I'd go back to stop market here, do a sell because I'm in a 10 contract long. I could set if I'm willing to take a 3 tick loss, then I could put 93.35 in there, 10 contracts, and place order. And so now I have a stop loss at 93.35, which is a stop market, which is what I want, and I have my take profit sitting up here as a limit order that I clicked on the ladder to place. And so this is how I would probably set up the trade. I wouldn't use take profit up here for that, but I'll show you how they're used if you decide to use them. So I'm going to go ahead and cancel out of this, right click right here, get out of that position. And so for a take profit, well, I guess I should have stayed in that position. We'll click back here. So we'll get back into a long right here. And so For the take profit, you have a limit and a market just like you did for the stop. So you have the same, it's almost the exact same thing. It's just this is for getting out of your position. So what we'll do is we'll start with take profit market. It's just going to be just pretty much like a stop market. It's just for take profit. So if we're in a long position and we want to take profit at a certain level, and we want to make sure that we get filled no matter what, because if you have a limit order, let's say that I left click up here and I have a limit order at 93.70. When this spot price hits 93.70, that does not mean I'm going to get filled on these 10 contracts. They have to, there were contracts before ahead of me right here at this level that would have to get filled first at the time that I placed the order. So even though the spot price can get up to 93.70, if I have a limit order up here, that doesn't mean I'm going to get filled. And so if you want to make sure that you get filled, then you can do a take profit market whenever a certain spot price is hit. And so that's the benefit of using the conditional take profit here. And so in this case, we're in a long, so we need to do a sell order to take profit. And the spot price is the trigger. We'll say I'm going to do 93.50 just so we can watch this execute. 10 contracts at 93.50. And so what that'll do is it'll do a market sell order of 10 contracts at 93.50. As soon as the spot price hits 93.50, it'll do a market sell order of 10 contracts. So I know that I'm getting out when that spot price is hit. But if I had a limit of 10 sitting here, I don't know that I'm going to get filled whenever the spot hits 93.50 because there's contracts ahead of me. So that's the benefit of this take profit market. So I'm going to go ahead and let's actually change it to, we'll keep it at that. We'll keep it at 93.50. Place the sell order. We get the notification. You can see it pop up down here. All the same information. And so now we're waiting for the spot price to come up to 93.50. Now since we're triggering on the spot price could come up to 93.50, but we're still trading at 93.45, so I might actually get out at break even instead of one tick profit. But that's just how it is with the spot price as the trigger right now. If the futures price was the trigger in the future when that gets added, then I actually wouldn't get out until 93.50 was traded on. But the spot price can go to 93.50 while the futures price is actually still trading down here. So just because the spot price goes up here doesn't mean I'm going to get filled at 93.50. It just means that it's going to get me out whenever the spot price hits 93.50. So I might still end up getting out at 93.45. So let's see if we can get the move up on the spot price right here. We'll give it a second. Alright, we had 93.50 hit here on the spot price, and you can see that it exited us out of our position. It took profit as soon as the spot price hit 93.50 there. So you can see that work perfectly on that long position there. Okay, so now we can do a short position for an example. So I'm just going to click right here and sell into the 288 contracts there. So now we're in a short position, and we want to do a take profit market buy. And so we'll have a profit somewhere down here. Like I said, we can do a limit order like this. If you don't want to do a conditional, that's what I would typically do. But if you're going to do a conditional, you can do take profit market, and you'd be doing a buy because you want it to cancel you want it to close out the 10 contracts short. And you could set it anywhere down below that you wanted to get filled. So let's just say, 2 ticks profit, we could say 93.20, 10 contracts, place order. And so now we have a take profit market order at, as soon as the spot price goes lower than 93.20, it would execute our take profit market order of 10 contracts. So it would be a market buy order of 10 contracts whenever the spot price hit 93.20 to get us out of this position. I'll cancel that. We'll just go ahead, we'll stay in this position here so I can show you the take profit limit. So with the take profit limit, what you would be looking for on this short right here is if we were going down into profit, to a lower price here, you would want to, and you can see you have all the same you have all the same things that you would have on the stop market limit that we went over for this take profit limit. And so you have, the criteria for how long the order stays open. You got, the spot price, and then you have the trigger price and the limit price. And so the trigger price is, what price do you want this limit order to be triggered at? And then the limit price is actually where the order is going to be placed. And so if the price is going down in our favor, and we get down to a certain level, where do we want the trigger price? So let's just say 92.80. At 92.80, when the spot price hits 92.80 or less, that's when it will place our limit order at the price we specify right here. Now we can place that limit order wherever we want. So if the spot price hits 92.80, we can place it to where the limit order is down below somewhere, so that it places it somewhere down here. So let's say if it hit 92.80 and we had 92.60 in right here for the limit, then if 92.80 gets hit on the spot price, then 92.60 would be where the limit order gets placed. And so a limit order would show up like that in 92.60. Now, let's just say if the trigger price at 92.80 gets hit and we want the limit price to be up above, so we actually get filled, because if the spot price is down here and it triggers at 92.80 and you place the limit order up above to buy, then you're most likely you're going to be getting filled because you're up above where the price is actually at currently. So you might want that. So at 92.80, let's just say at 92.90, you would have the limit order. And so in this scenario, if the spot price got to 92.80, then it would place the limit order at 92.90 like that. And so that's how that works. And for the sell, it's the exact same thing. So if I get out of this, position right here, and get into a long position, and it would be the exact same thing. So like if the price is going in my favor up and I'm doing a take profit limit, then I can do the exact same thing. So if I want to trigger at 93.30 to trigger either a limit order up above or down below, then I can specify where I want that limit order to be placed right there. And so I don't know how much anybody will use these. Stop market is definitely useful, and I want to show you how to open a position. So let's get out of this position right here. So if you wanted to open a position, and I'm on testnet, so you can see all these crazy wicks and everything on the chart. If I was on mainnet, you wouldn't be seeing that. But if we go over here, let's do something like this. So you can see, like, this was kind of support right in here. You can kind of see that this was like a line of support, and then once we broke below that, we had kind of a move down. And so what you could do is, if you weren't going to be at your computer, if you're going to be even going to sleep or whatever, you can actually set an order to open a position on the break of an important level. So if you do your technical analysis or whatever kind of analysis you do, and you determine there's an important level that you want to have a breakout order on, then you can set that using a conditional order. And so let's just say that on the break of this level you wanted to go short. So this level is around 93.10. So what we could do is come in here and do a stop market, and this is where you're going to have to select this, because we're not in a position right now. So anything that we do is going to be increasing position, so we need to allow for a position increase because we're at 0 right now. And so what we can do is do a stop market sell, because we want to short when we break this level. And so this level is 93.10. So we'll say when the spot price breaks 93.10, we want to go short 100 contracts. And so in that scenario, whenever I place this order, it will sit out here until the spot price gets below 93.10. Now currently the price is below 93.10 already, so it would trigger right away. So if I do this, it triggers right away and we're in an order because the spot price is already below 93.10. So let me just get right back out of this, and if we do this again, we'll just say maybe this level is a little bit lower, something like that. So we'll say 9300. So at 9300, we want this to trigger 100 contracts short, and we can set this and forget it and go to sleep, do whatever we want to do, go away from the computer, and we'll have an order that will trigger whenever that level gets broken. And so you can see the spots at 9307. Once it hits 9300 or less, it'll trigger this 100 contract market sell. And so this is a good way to catch momentum and get into the market when you're away from the computer, and you can have these orders set. And so same thing goes for if you were longing. So if you do something, whatever, there's some kind of level like this that you might break out of. So like 9400, somewhere right in here. If you wanted to have an order set, so throughout the night, if the price was doing something like that, and then eventually broke out of here, you want to have an order set right here to be able to catch that right here on the break of 9400. And so what you do is a stop market buy, type in 9400. And then you have 100 contracts, allow for position increase, and place order. And so you can see it down here. It'll sit there until it's good till cancel, so it'll stay there until you actually cancel it. And as soon as spot price breaks 9400, you'll be in 100 contract long. There is better functionality coming that will be much easier to use on the ladder interface, but it is still in development. So currently right now what we'll have to use is this order box right here. I hope this video was helpful, and I will see you guys next time.